Thank you. And thank you to Noemi and to you for inviting me. Our relationship with UNAM goes back 20 years. And I remember many great times with meeting a lot of people. Some of them are in here today. Monica Mialis, for example, and others that I've just seen their names. But thank you very much. It's always a pleasure. My only regret is that I cannot be there in person. I would love to have a little bit of 25 degrees right now, but it is what it is. So this is today. So this is a 2-day presentation, and what I want to do is sort of a very step by step. Today, I want to deconstruct the mainstream model. Step by step, everything about that model is going to be opened up and explored. And at the end of the day, we're going to find out that there's nothing left from that model. And hence that the question in the presentation, from ineffectiveness to impotence, to irrelevance. And my argument is that the mainstream model is irrelevant. To me, it's irrelevant. And having done that, the next day, tomorrow, I'm going to rebuild the model about central banking, but along more heterodox grounds, putting concepts like vested interest and power, hierarchical relationships at the center of the analysis of central banks, which means that we have to place central banking at the intersection of society and the forces that we have to deal with like power and all of that, and income distribution will be placed within, back into the model of central banking. So I'm going to share my screen now.
Louis-Philippe, only to remind you to be slow.
Yes.
And si hay alguna palabra que no se entienda, por favor, por el chat podemos traducir rápidamente. Hay muchos que nos pueden ayudar. Entonces, sorry, go ahead.
Okay, I will try to be very slow. And so let me begin with just explaining a bit of the picture. This is in fact in front of my house. The neighbor had put, this is a washing machine out, and it was all deconstructed. And I thought it was an interesting metaphor for what I wanted to do today. So, you know, I took a picture of it in order to place on here. Now, let me see how to, okay. So a little bit about myself, for those who know, I created the review of Keynesian economics some 10 years ago. I am now the editor-in-chief of the Review of Political Economy. And also I'm a consulting editor on a brand new journal that's coming out with Edward Elgar called Advances in Economics Education. And I'm on the editorial board, but I don't have anything to do with the management. I just helped them set it up. And it's a journal that will be dedicated to issues about education and economics education. I'm also the editor-in-chief of a series on central banking that I'm currently doing for Elgar. And the first 5 books of that series will be coming out later this summer. And, you know, they have, some of these topics are going to be discussed over the next couple of days, but the future of central banking and income distribution, central banking and the environment, central banking and the future of money, all this discussion about e-monies, how does that impact on central banking and monetary policy, and central banking, monetary policy, and social responsibility, the role or the connection between central banks and democracy. And, you know, notice that all of these titles are not just monetary policy, they're about central banking and monetary policy. So central banking as an institution. The next book that I'm doing, that I'm currently working on, is about central banking and gender. And how does that institution of central banks deal with gender issues? So, a lot of, like I said, the topics that we'll be discussing over the next couple of days are in these books. And it's certainly a very appropriate time to be talking about central banks. They are about to take a very central and leading role in economics. One, well, because inflation is on the rise, and there's questions about what should central banks do about inflation. And we know that, that this is what we're going to be talking about today. The traditional role that we see, that we assign to central banks, is that in terms of inflation, they use monetary policy, interest rates, to increase interest rates in order to bring down inflation. But that assumes a relationship, or what we call a transmission mechanism. And we're going to be looking at that transmission mechanism. And what we're going to find out is that empirically, there's no validity to that mechanism. And that brings into question what central banks, what monetary policy is, and what it does, and what it should be doing. But even if that relationship did exist, monetary policy is about demand pull inflation. And everything we know right now about inflation is that current inflation has nothing to do with excess demand or, growth or any of those demand explanations of inflation, but rather about costs, and more notably about bottlenecks. And so the question remains whether raising interest rates would have an impact on inflation if the source of inflation is not from demand, but rather from supply. And I would argue no. I can't see how raising interest rates will solve bottlenecks or will solve issues regarding getting goods to market. So big question mark. And the other question is, well, what if central banks raise interest rates? What will be the consequence if everything I say today, for example, is correct? And in my opinion is, well, we're phasing down the barrel of another recession. Recession question mark, financial crisis question mark, because another issue is the imminent Russian debt default. So if we are to believe reports, Russia is about to default on its debt yet again. And that might have an implication on financial markets, for central banks. And that scenario with rising interest rates might lead to a recipe for another crisis. And that's not atypical of the way we see financial crises today. If you look at the history of financial crises, there's a great Wikipedia page on it. You'll see that financial crises in the history of capitalism were once every 200, 300, 400 years. But now financial crises are by decades. And, I'm not sure exactly when it started, but certainly the idea of capitalism as being based on a series of financial crises goes back to maybe, don't quote me, but I'll say 40 years, just because that's the beginning of, the neoliberal era. So, this has to be validated empirically, but this is what I think. And so episodes like the tequila crisis and others, the Argentinian crisis, and now the Russian crises are bound to repeat themselves on a more regular basis. And that's, I would argue, linked to, in part, to central banks. In this case, the Russian default is linked to other other things, but central banks certainly play a vital role in this. And, the research by Noemi Levy, for example, on crises and et cetera, and financial factors is a good point of reference. So I'm not too optimistic about what is going to happen. But what I do want to do today is talk a little bit about that model of central banks. And, at the end of the day, we will be left all very pessimistic, I'm sure. Okay. So let me begin and so what I want to do today is going to be just very technical, very economic technical. And tomorrow's class is going to be more sort of, Veblen-esque and Polanyi and all of those great thinkers and some Keynes. And we're going to be talking more about political economy rather than pure esoteric economics today. So let me begin with an overall definition of neoclassical theory, because I think that definition will apply perfectly well to monetary policy. So I think that the two words that summarize neoclassical theory quite well is the word convergence and the word stability. And even today, even post-financial crisis of 2007, 2008, if you look at most models today, those concepts is still very much at the heart of it. It is still a model of equilibrium. They may tinker on the side with some sort of instability, but it's very short-lived, because in the long run, everything is very neutral, and there is these centers of gravitation that ensures the stability of the model. And there's a lot of borrowing from the concepts of physics, stability, convergence, equilibrium. These are all concepts born in physics. And even some of the classical economists saw physics as an inspiration for economics. Adam Smith had a book on the history of astronomy where he talked about the Newtonian system, which should be at the heart of the natural world. There's also this concept of the universality of economic laws, which apply at all times, at all places. You guys in Latin America are well aware of the attempt to impose Washington consensus type of policies, the idea that what's good for developed countries must be good for developing countries. So the universal, and we saw the disaster that caused. There might be a little bit of rethinking about that. IMF is flirting with some ideas, but even then, IMF policies, if you look closely, some of their newly found policies are applicable to developed economies, but I don't think there's been much of a advancement in terms of thinking with respect to developing countries. So all of these models, the neoclassical model, are fair weather models. This is what we call fair weather models. They're excellent to talk about disturbances that sort of, come back and your model kind of shift a little bit in the short run. They come back to, to the long run stability. And we know that the Queen of England had asked the economists in 2009, why didn't you see this financial crisis coming? And the answer was, well, our models just didn't predict. Our models don't predict crises. And so, you have to ask questions about the validity and the relevance of these models. And then this applies, in my opinion, to the model about central banking and monetary policy. It's all about centers of gravitation. You have natural rates of interest, natural rates of growth, natural rates of, inflation, natural rates of output, and, of unemployment. You have all these natural rates, which are what? Which are centers of gravitation in the long run. And even when neoclassical economists venture out and we'll explore this a little bit tomorrow, and they look at the relationship between monetary policy and income distribution, or monetary policy, and the environment. They're all there to say, in order to justify the validity of their thinking, they all say, oh, yes, 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 this is all relevant. Monetary policy does have an impact on the environment and on income distribution and on gender and all that. They admit all that, but then they go and they say, but these are all short-term problems, because in the long term, the model must respect the long-run neutrality of policy, including monetary policy. And I've got some great quotes from scholars and central bankers that says, yes, central banking used to have central monetary policy has all these consequences, but they're all short-lived. And so maybe I should have added directly to the question, to my topic today, inefficiency, impotence, and irrelevance. Anyways, and then, this brings up the question of black swans and exogenous shocks from, and the model, the standard mainstream model, they can't predict these crises, and that's why they're categorized as black swans, right? But for me, from a heterodox perspective, I don't believe much in black swans. For me, kind of everything is sort of endogenous, even the ecological, especially the ecological crisis. These are endogenous forces, crises, cycles. These are all endogenous. So I'm not sure exactly what, from a heterodox perspective, could be defined as a black swan. I think that if we dig a bit deeper, we would probably be able to, link it to some sort of endogenous impact on the environment, and et cetera, et cetera, et cetera. In any event, that's an open question. We can discuss that. So, we are under an inflation targeting regime, which is basically the central bank targeting a very specific inflation rate. And in Canada, in the US, in most countries, it's either directly a 2% inflation target or a corridor system with the inflation between 1 and 3%. And so on average, the central bank is looking for an inflation target of 2%. And, the model is, if inflation is above inflation target, like right now in Canada, it's about 5%, 8% in the United States. These are clearly above the central bank target. And so we, as expected, we find central banks now starting to increase rates and threatening with, several other increases this year and next year. And, the whole purpose of monetary policy here is to, is for the interest rate to be equal to that neutral rate, or that natural rate, which could be as high up as 3% in the United States. So you're talking about, 10, 11, 12 possible increases in interest rates, because it's only at that interest rate where inflation comes down to target. And, that brings up questions about whether that's going to create more harm than solve any possible problems. Anyways, leading up to the current system, I'll talking about the current model in the next slide, but leading up to the current system, we know that the end of Bretton Woods in 71, we had the oil shocks in 73 and 79. These were very a period of the collapse of the Keynesian model, collapse of the Phillips curve, an important concept that we'll be looking at. But these were very inflationary, and a very inflationary decade, and which has contributed to the rise of monetarism, the debate over rules and discretion. But it was a lost decade because central banks basically lost control of the money supply, not not a big surprise for heterodox economists, but nevertheless a lost decade. And the whole concept of rules and discretion, I just wanted to point out that Friedman was against the concept of discretion. He favored rules because he had a deep mistrust of central bankers. He opposed the idea of leaving wide discretion to independent experts. I mean, that paper by Friedman is a fantastic paper, and I've got a paper coming out in the International Journal of Political Economy where I sort of discuss this paper a lot because it's quite a gem. If you want a reference to it, I'd be glad to supply it. But during that lost decade, a couple of things happened. First of all, like I mentioned, central banks lost control of the money supply, that they were under the impression that they could control. And as a result, interest rates shot up to 20%. Another concept that was part of that lost decade is the realization that the natural rate of unemployment was moving around all the time. So it could no longer be an anchor for monetary policy. And so today, central banks don't talk much about natural rates of unemployment anymore, but they do talk about output gaps. So that was sort of an interesting development, which led to the sort of collapse of that model. And during the 80s, the experience with monetarism. And, that has led to discussions over inflation targeting. And with New Zealand in 1990, Canada in 1991, now some 30 more countries are inflation targeting around the world. And like I said, the approach to inflation targeting is seemed to be sort of very similar amongst countries, a target of around 2% on average. But what I want to argue is that the model has some very basic assumptions, which are proven to be problematic. And I really love this quote by Phil Orestes and Malcolm Sawyer. It's a long and uncertain is the key word, and long as well, chain of events from an adjustment in the interest rate controlled by the central bank to a desired change in the rate of inflation. And that sort of anchors the presentation today. If you prefer Keynes, he said that there are several slips between the cup and the lip. And once we deconstruct the model, we're left with maybe, rather than new consensus models, maybe we should call it the new obsolescence model. Okay, so let's talk about the model, new consensus model, which I think is more of a post-Keynesian expression. I don't think you see that expression used as much by the mainstream. For them, it's the neo-Vixelian or even the new Keynesian model. And, we go back to Woodford's early model paper. We go back to Romer, who wrote that paper, A Monetary Policy Without the LM Curve. And of course, we can go back to Taylor and quite a few. So, but this is, and in my book in 1999, in fact, in the last chapter on mainstream theory, I kind of talked a little bit about that. It was still very embryonic at the time, but it's in there. And there's the concept of long-run neutrality of money is still very much in that model, despite the fact that they sort of have this theory of endogenous money, which I don't really accept, but I'm not going to discuss. For me, endogenous money implies the rejection of the natural rate of interest, which this model still maintains. So big question mark for me on that, but that's a side discussion. But money is still seen as related to money or aggregate demand, or in fact, monetary policy. So if we don't have Friedman's direct quote that money is always and everywhere a monetary phenomenon, it's still very much a monetary policy phenomenon. And hence why monetary policy is considered dominant in the discussion over inflation, right? In fact, fiscal policy is completely absent. If anything, fiscal policy is considered inflationary. So there's absolutely no role for fiscal policy in this model. It's all about monetary policy. And, central bank independence, still very much intact, at least in theory. We could certainly start talking about whether the European Central Bank is demonstrating independence right now or not. But, that's certainly a question mark as well. But in theory, if you read the latest literature, they still talk about central bank independence. And of course, the model, as I said, permeates with natural rates of interest, unemployment, growth, output. And I would even add the natural rate of inflation, which is the inflation target. If 2% is consistent with all of these natural other rates, then 2% must be considered a natural rate of inflation. And of course, anchoring agents' inflationary expectations is crucial and is at the core of this model. And, in the communications of central banks and central bankers, the idea of communicating to agents, is paramount. And the whole concept of wanting to anchor inflationary expectations around the target is clearly at the core of this model. I mean, one of the reasons advanced that concerning inflation targeting and the fact that it is perceived to have worked. Why? Well, because inflation has been at 2% for the last, 20 years, 30 years. They claim is proof that inflation targeting works. Open a discussion about current inflation rates levels, but anchoring inflation expectation is key, except in a new paper by Rudd in Roche right now in the current January issue, that paper kind of created it was first published as a working paper for the Fed, I think the New York Fed, I'm not sure. And then he was invited to submit a revised version to Roche. And, Rudd's paper is very interesting. He basically says that expectations are not important. And so the whole idea of communication and et cetera just is not supported empirically. He says it rests on extremely shaky foundations. So there's no empirical support for that. Okay. Now, let's look at the Taylor model or the new consensus model. Taylor argues that this represents, the new model, the modern view of macroeconomics, and the model itself is quite elegant. I mean, it's nice, it's simple, it's elegant. My God, it's 3 equations. Who can't like that? There's an IS curve, which means there's an inverse relationship between real or nominal rates and output via consumption and investment. So those are the interest-sensitive components of aggregate demand. So the IS curve, interest rates go up, consumption and investment should come down. Fine. There's a Phillips curve, an inverse relationship between inflation and unemployment. So if you look at the IS curve, if interest rates go up, unemployment goes up because output comes down. And if unemployment goes up, Phillips curve tells us inflation must come down. You see that? And then there's a reaction function, which contains a natural rate, which has been called the Taylor rule. And so that rule will dictate that interest rate goes up and down relative to what's happening to the inflation rate. So if inflation is above target, we raise the rate. And by raising rate, equation 1 tells us that output comes down and unemployment goes up. Equation 2 tells us if unemployment goes up, inflation comes down. So you use interest rates in a countercyclical way to try to create a situation of a soft landing where the economy sort of just gravitates towards equilibrium with very little cost to the overall economy. That's the theory. And, you know, like I mentioned a couple of slides ago, this is nothing new. This is all rehashed monetarism, leftover monetarism, which is what prompted Marc Lavoie to say this is old wine in a new model. The only thing that could be seen as different is equation 3, a reaction function. But, you know, it's interest rates rather than money supply. But I had a conversation with Benjamin Friedman, when I was writing my dissertation in the late 90s, and I emailed him and I said, you know, you have models with interest rates. How come? Why not money supply targeting? And he wrote back saying, doesn't matter. The model stays the same. And that reference is in my book, in fact. And you know, he's right. You've just exchanged one control variable for another, and you've left everything else the same without thinking whether that has consequences. So this is, you know, the model, very elegant, very simple. You have a Taylor rule here. You have the inflation gap, the output gap. So if inflation, and these are assigned weights, gamma naught and gamma 1 are weights. And, you know, in most models, gamma naught is closer to 1. Today, with sort of flexible inflation targeting, maybe gamma 1 is given a little bit more weight. But I'll have a little bit of something to say about that. But if inflation is above, interest rates go up, and you have that IS curve relationship, then that Phillips curve relationship. Fantastic. Well, let's explore the model. There's 8 things I want to talk about. The inflation targeting as a policy itself, the IS curve, the Phillips curve, the natural rate of interest, the concept of fine-tuning, demand side inflation, which I talked a little bit about before, CBI, I want to go back to that a little bit, and finally, the concept of monetary policy dominance, which was a subject of a series of paper I did with Mark Setterfield that you may know on interest rate, post-Keynesian interest rate rules, which has become sort of a dominant now in the post-Keynesian literature. So, yeah, inflation targeting, not much difference. Central banks were always preoccupied about inflation. The only thing that's different, and if you look at the literature, is that they argue that in the past, inflation expectations were not anchored. Q. Rudd's argument, but they're not anchored. And so therefore, the innovation with inflation targeting is precisely that. Now, we may have a side discussion about why this obsession with inflation, but that has to deal, I think, with vested interests and all. Anyways, but you know, it's an old idea. Even Irving Fisher had written about something very close to the idea of inflation targeting back at the turn of the century, previous century. So an old idea. But in today's system, as I mentioned, 2% is the target. But why 2%? And in fact, I went back to read a lot of literature and especially with at the Bank of Canada, which was one of the first inflation targeters, the Bank of New Zealand, and I read, you know, other stuff, and it's very difficult, if not impossible, to find a justification of why 2%. And it matters because if inflation targeting, if they had agreed on an inflation target of 5%, for example, you know, we might be having a very different conversation around inflation today and around monetary policy. So the choice of the 2% is very important. But Benjamin Friedman wrote in this brilliant paper in 2018, which was in the Festschrift for Constancio. He writes, there is the arbitrariness, right? Such beautiful words, arbitrariness surrounding the current 2% target. In retrospect, the paucity, meaning the lack of serious empirical research underlying the identification of the 2% norm, now quite some time back, listen to this, is a professional embarrassment. I mean, these are strong words coming from someone who is a key figure in the mainstream Keynesian literature. So, yeah, there was zero or very little empirical support, discussion for a 2% inflation target. Emmanuel Carré, a brilliant French economist, heterodox economist, in a paper published last year, wrote, economic theories have played a limited role in the creation of inflation targeting. And I interpret that to mean the same thing. I mean, there are theories because, the model is based on Phillips Curve and IS. There are these theories, but I think that there's no theory of inflation targeting, very much in the same line as Ben Friedman's quote. Now, the question of whether IT has been successful, these are old quotes, and I'm trying to, except for maybe Boreal, but there's no empirical, not lots of empirical support for the idea that's inflation targeting central banks have been more successful in bringing down inflation. And in fact, if you look at today, inflation is on the rise despite the fact that those central banks are targeting. I'll have something to say about inflation, why it's been successful. I think it has been successful, but I'll explain to you why. I think it has been successful because central banks have weaponized inflation targeting. And look at the comments of the governor of the UK central bank a couple of weeks ago, where he said workers cannot ask for more than 2%. Right? So you have unions, you have wages not increasing, stagnant, and that's why inflation has been low, and that's why people can claim success over inflation targeting, but not because of anchoring of expectations, but because it is being used as a threat against workers. And as I say tomorrow, it's based on conflict. Okay. So these two quotes, and there's also other quotes and I haven't put them there, but I have a bunch of other quotes that says that basically it is also just a question of luck. That's the expression they use. We've just been lucky for the past 30 years with inflation when it comes to inflation. Now, I don't think it's luck. I think it's oppression of workers and workers' demands for higher wages. But anyways, and Boreal here says, have we overestimated our ability to control inflation? Well, we'll soon find out, but I think it's yes. So that was a discussion over the inflation target itself. No real empirical support for a 2% target. Okay, so that's one notch in the model that we've kind of knocked down. How about the other one? Well, this is your traditional IS curve, where central bank, the MP curve as opposed to the LM curve. It's monetary policy curve. It's sort of a, target interest rates. Great. And this is your IS curve. So, as predicted, if you move that interest rate, you're moving up and down along that IS curve, and you are going to impact your interest sensitive components of aggregate demand in the right way. So this curve is said to be well behaved, and it has to be elastic. Because if you can imagine an IS curve that's inelastic, well, monetary policy loses degrees of freedom. So you have to have that curve more or less, a nice elasticity such that you can have a good range of impact on output. Okay, well, except that, there is lots of empirical support questioning the validity of the IS curve. Stephen Fazzari is one who has done a lot of research on this. And, he's part of this quote in a book that was edited by Barry Cinnamon, Stephen, and Mark Setterfield, in which, they say, there's no relationship between interest rates and consumption, or interest rates and investment. Now, let me say this. I don't think that's entirely true. I think there is a relationship. What this quote should have said is that there's no relationship between incremental changes in interest rates and consumption and investment. But if you increase your interest rate 10, 12 times, which central banks do, eventually you will collapse your economy, right? But yeah, I mean, raising interest rates from 0.25 to 0.5 to 0.75 to 1, you're not going to have that desired IS output impact right away. Okay, so this is a bunch of heterodox economists. Who cares? Well, how about people from the Federal Reserve in New York, Sharpe and Suarez? Paper is not all that old. A large body of empirical research offers mixed evidence at best for substantial interest rate effects on investment. Our research found that most firms claim their investment plans to be quite insensitive to decrease in interest rates, right? You can bring a horse to water, you can't make it drink, and only somewhat more responsive to interest rate increases. Well, that calls into question, right? The determination of the investment function. What is it? What does investment depend on? Well, statistically, apparently not the interest rate as a solo variable. So there must be something else going on with investment. And, we know what's going on with investment. But anyways, and then Krugman. Krugman says it's a dirty little secret of monetary policy that changes in interest rates has no direct effect on business investment. It's so small that it's hard to even see it in the data. What drives such investment is instead perceptions about market demand, and I would certainly agree with that. And there's probably something about the effect of interest rates on housing market. Maybe because, and again, we have to differentiate between incremental changes in interest rates and interest rates. But so there you go, a 2019 IMF paper. There appears to be little unexplained component of business investment beyond the expected demand effect. There appears to be little unexplained component, right? Interest rates is part of that unexplained component. Other factors, such as the reduction in the cost of capital, thus appear to have played a relatively minor role. So whereas, I was quoting some post-Keynesians before, but now I'm quoting IMF and Krugman and Federal Reserve Bank. So, okay, the conclusion is that IS curve must either be fairly inelastic or some sort of maybe weird L-kinked shape or something, but it's not your well-behaved IS curve. Now let's talk about the Phillips curve. Sorry, I couldn't do a curved curve here. But again, inflation, unemployment, you have this inverse relationship, which for decades led to the discussion over policy mix or policy choice, where you had to choose between unemployment or inflation. In contrast to, post-Keynesian or MMT literature that says, you can have low unemployment and low inflation. But that requires a correct interpretation of what inflation is. But there you go. This is your sort of traditional mainstream model. In post-Keynesian economics, the Phillips curve would be something like this. You have a long, flat component, which you would have various levels of unemployment corresponding to more or less a fixed inflation rate. And if you look at the data in the last 40 years, that's sort of what we've had. We have had inflation rate hover around the target, but at various levels of unemployment. Okay. Well, let's talk about the Phillips curve. And wow, that's just a can of worms. And I must have, and I'm not kidding, about 100 quotes from people saying there's no Phillips curve. Okay, Claudio Borio, who's perhaps one of my most favorite mainstream economists at the Bank for International Settlement. The response of inflation to a measure of labor market slack has tended to decline and become statistically indistinguishable from zero. So he's saying that statistically, the Phillips curve is completely horizontal. Oh, I've put the same quote twice. My apologies. Arestis and Sawyer. Oops. Anyways, I don't know if I know how to go back. But again, another quote, Bob Solow, who I published, Bob Solow, who won the Nobel Prize. I published Bob's, this is from a paper that I published in Roque on that special issue on Friedman that I did. The slope of the Phillips curve itself has been getting flatter. Bob Gordon, this again in the same issue of Roque that I did, the slope of the short run inflation unemployment relationship has flattened. Janet Yellen, a measure of the responsiveness of the chain to a decline in labor market slack has diminished very significantly since the 60s. So there's a huge, but if you think about monetary policy depends more so on that Phillips curve. And that led just a couple more quotes. This is from the labor statistics. Politano, who I follow a lot on Twitter, he's got very, very good informative papers. It's broken down, etc. I'm not going to read all the quotes. But one of the consequences is if you don't have that Phillips curve, it causes a lot of problems for central banks. And that's why you have a lot of papers on the quest for the new Phillips curve. Some people think that the Phillips curve is there. It is through real estate market. That's how you have an impact. Anyways, so we've knocked down the concept of the target of the IS curve of the Phillips curve. Natural rate of interest. I'm not going to spend any time on this because we all know that it is a completely false concept. Here's a couple of quotes that says that, but there's literally hundreds more. And I remember being at a conference and I asked Charles Goodhart. I asked Charles Goodhart at a conference and I said, if you know that the natural rate doesn't exist, what do you do? And his answer as a central banker was, oh, well, you just assume that it works. And, remember the joke we tell in economics about the can of beans and how about we just assume the existence of a can opener. How do you open the can of beans? You assume you have a can opener. It's it's the exact same thing. And this is what I certainly took from his answer. Oh no, I don't know how to go back. Let me, there you go. And so in terms of fine tuning, number 5, fine tuning, it's using, if you have an old fashioned radio from your grandparents and you're trying to get that radio station, and then you turn the knob back and forth until you get precisely the channel. But first of all, I want to say this is not what central banks do. They don't fine tune. Mark my words, fine tuning would mean that interest rates just went up in many countries. They're going to bring it down. They're going to bring it up again, maybe a couple of times. They're going to bring it down. That's not what central banks do. Once they start raising interest rates, they raise interest rates, 10 times, maybe more. That's not fine tuning. That's, turning the knob completely to one side. But look at Joan. Look at good old Joan. This is a fantastic pamphlet in 1943. She did a presentation for, the UK Workers Union, and it was published as a little pamphlet, and it is fantastic. And, she says the regulating effect of changes in the rate of interest was at best very weak. She's challenging this concept of fine tuning. In 1952, she goes back and she calls it a false scent using countercyclical monetary policy. And she rejects the conception of an economy which is automatically held on a path of steady developments by the mechanism of the interest rate. Fantastic. And, this is what Setterfield and I wrote a decade ago or more. Because reaction functions rely on fine-tuning the economy as needed, the central bank's policy obsession with inflation often translates into repeated increases of the rate of interest until the economy finally deflates or collapses in the misguided pursuit of a soft landing. This is what I called, in the paper called, I called it the Holy Grail, the pursuit of the Holy Grail. And, a bunch of post-Keynesians have commented on that. Inflation control can be achieved only at the cost of large losses in economic activity, by Mark Lavoie. So yeah. It's not fine-tuning. It's just turning the interest rate knob to the extreme, collapsing your economy, and then, asking what went wrong. And then, in the book on central banking, monetary policy, and social responsibility, some of the authors tackle that question. And if you remember John Smithon's book about the revenge of the rentier, there are always winners and losers, even with monetary policy. Now, the focus of tomorrow's talk is seeing the rate of interest as a source of revenue. And you crank that interest rate high, you are basically giving rentiers increased revenues. And you collapse your economy, create unemployment, the wage share goes down, workers are left holding the bag. So monetary policy is indeed rooted in conflict, what I called elsewhere a class bias, right? There's an inherent built-in class bias in central banking. Talk about that tomorrow. Okay. Let's talk about demand-side inflation. Well, monetary policy could theoretically, according to them, work if inflation was a result of demand issues. But what we've done up to now is we've completely assaulted every single argument of that model. And even if inflation were demand determined, you still have a black box. You're still left with a black box because you have to justify how do changes in interest rate through that black box affect inflation. Well, those mechanisms that we discussed don't seem to be empirically valid. So what other way? Maybe through exchange rates. That's a possibility, which you guys would know a lot more about. But certainly that's, a real mechanism. And maybe in the end, that's all that is left of that sort of demand side impact of monetary policy. But even if, oh, and then, you know, as I argued it very, very early on, post-Keynesians are of the opinion that much of inflation is explained through supply side or wages versus productivity issues. And with wages being stagnant over the last 3 decades or so more, you know, playing with interest rates won't affect that. So the model becomes irrelevant, completely irrelevant in a situation where inflation is more the result of supply side considerations. You know, and you do have a lot of, Jeremy Galbraith sort of had a piece recently in the last month where he argues, without agreeing with it, but he argues what the central banks are doing is they're going to start raising interest rates. And despite the fact that much of inflation is determined by supply, there is a little bit that's determined by demand. And that's what they're going to try to weaken. And to do that, they're going to have to raise interest rates a lot so that that affects that demand component sufficiently that it brings inflation down. I'm not, anyways, yeah, for me, it doesn't matter. Okay, so central bank independence, I'm not going to say a lot on it, but, you know, I mentioned Friedman being against independence, but it is a dominant sort of argument in the literature, in the theory at least, the idea, and especially now with inflation, we see these arguments of central bank independence coming back because we're saying that central banks must be independent of governments in order to fight inflation, right? That's the traditional argument, except I don't think central banks are independent at all, because if we believe Jerry Epstein in his sort of Weblerian argument of vested interest, and Mario Siccarreccia, who wrote a paper 3 years ago, 4 years ago, in the Journal of Economic Issues on whose vested interests are central banks protecting, we can't help but conclude that central banks are dependent on the opinions of financial markets or Wall Street, right? You know, the dominant idea behind central banking is the concept of credibility. And they do not want to lose credibility, so they must therefore appease the interests of markets, Wall Street. And one of the things that they want, that Wall Street wants, is a reduction in that interest rates. Inflation erodes wealth. And so by eliminating inflation, you restore or you increase real wealth. And so the pursuit, when I asked at the very beginning, why are central banks obsessed with inflation? Because they are obsessed with catering to the needs of Wall Street. They want to make sure, and you know, they come from those circles. You know, president of one Wall Street firm becomes governor of the central bank, et cetera, et cetera. So they're all from those circles. So Jerry Epstein's, where central banks are independent of the executive branch of government, they tend to be dependent on the financial sector for political support, for legitimacy, and therefore tend to make policy with finance-colored glasses. So this, I think, is an accurate sort of interpretation, which will be the focus of tomorrow's talk. Finally, monetary policy dominance. I just wrote a blog that was published this week where I argue this. I mean, what is the problem we're trying to solve? If you're trying to solve inflation, you have to ask the question, are there other means of fighting inflation? Maybe there's a role for fiscal policy in fighting inflation. A few heterodox economists are coming out with policy proposals aimed at around the price and wage controls. I don't think wage controls is a big issue, but some sort of controls of prices and costs in some sort. I think there is some price gouging going on. I think there are companies who are taking advantage of the confusion to raise prices in order to raise profits. I think there's a lot of that happening. And, in the end, central banks probably can't do much about that, but there is a role for governments to play, fiscal policy to play in terms of maybe regulations. But, let's explore that because we know that monetary policy can be a blunt instrument, a very asymmetric instrument that can do a lot of harm if those interest rates are pushed too high. Conclusion. Well, so in the past hour or so, I've sort of deconstructed the model step by step. Every equation, every variable, every idea of the mainstream model. And we're left with the question of what's left. And, is monetary policy impotence? Now, this impotence argument was at the heart of Larry Summers' argument, right? He wrote a paper called Wither Central Banking. And, they're arguing in terms of low interest rates, lower bound sort of policies. And we all know since Keynes that you can't push on a string. And there's a great, I should have put that great quote by Joan Robinson. It's the exact same thing. You can't bring a horse to water and force it to drink. And so Adair Turner would say, yes, monetary policy is impotent at low rates. We know that. But my argument in terms of impotent is in fact much broader. I'd argue that monetary policy is impotent at low rates and uber non-impotent at high rates, right? It's the concept of asymmetry. Too strong at high rates, too weak at low rates. And so it becomes, its use is you have to use with very carefully. And that's the whole argument between those interest rate, post-Keynesian interest rate rules that I developed with Mark Setterfield, the parking it approach. And, for the record, all of those activist rules, activist post-Keynesians, Tom Pally, Bob Polin, and others who still advocate the use of monetary policy, fine-tuning, but they would argue in terms of a different target, some sort of real target like unemployment or growth or capacity utilization or something. For me, the model still suffers from the exact same criticism that I discussed throughout. So in the end, you can't have, any type of targeting or real targeting is not compatible with the true theory of endogenous money. And so QE, which I haven't even discussed, and I might discuss a little bit tomorrow. QE is the result of this impotence. It's the fact that central banks knew that there was nothing they could do, nothing more they can do once the interest rates were at the lower bound. And there was a search of trying to remain relevant in the discussion over the financial crisis and the COVID crisis. If interest rates are near zero, what else could we do? And that's where the concept of QE was born. But QE was also non-successful in terms of relaunching investment. And because that points to a much broader question about what does investment depend on, which we won't get into. We won't get into it tomorrow either. But it does point to a bigger question of what determines investment. So I think that's it.
Thank you very much, Professor Louis-Philippe, for this marvelous presentation. And now we have time for your questions. I don't know, you know, in the morning we had an incident, a hacker incident, and for this reason we can not open the mic. And we ask you that put your questions in the chat. We already have 3 questions. I'm going to put it for you to read it in this sense. Okay. The first one, I'm going to put it right now. This is the first one.
Are you going to read it or?
It's for you.
It's the relation between de-dollarization and the war, and whether we will shift to the Chinese currency in terms of the war, of the Ukrainian and Russian war. This is one. The second one is related to which
let me just ask, let me answer them one by one because my memory.
Okay. Here you have it.
Well, so let me answer the question of de-dollarization. Look, I think that I'm having this discussion with Lavoie and Secareccia by email this week. And my argument, and they agree, is that the loss of hegemony takes centuries. It doesn't happen over a few years. It doesn't happen over one incident like the Ukrainian war. You know, if you look at the loss of the British hegemony of the British pound, it took centuries, and it took a world war, and it took the reconstruction of Europe through the Marshall Plan, and these are forces that were in the making for a couple of centuries at least. With the US dollar, it's only been, you know, not even 100 years that it's been dominant. So I think that you're looking at many more years, many more decades. If you look at, you know, the US dollar is still about 61% of foreign reserves in most central banks around the world. You know, in fact, the Canadian dollar is held is about 3.6%, about the same as the Chinese currency. So I don't see the Chinese currency that may be taking over the American dollar anytime soon. I don't see the euro doing that either. It's not going to happen in my lifetime, and it may or may not happen in your children's lifetime. These are, you know, long waves of forces that I don't think are there right now.
By the way, the dollar has been dominant since 1930. So
yeah, well, that's what I said. I said it hasn't been
about 100 years by now.
Yeah,
it's
yeah.
90.
Yeah.
Anyway, I agree.
We have three more questions.
Well, I wouldn't say 1930. I would say the 1940s. It's with the Marshall Plan. What,
Yeah,
late
with the Marshall, but
so it's only been 75 years.
Down.
75 years, and I think it's going to take another, you know, I don't have a crystal ball, but you know, decades or centuries to bring it down. That's right.
Anyway, it depends who will win the war.
Okay.
The second question is the relation between policies, employment, no matter the inflation reaction.
So what's the question?
Do you consider
the
that policies might improve the employment no matter the inflation reaction?
So I'm just trying to figure out, I think there's a word missing in the question.
I think what policies may improve employment.
Okay. You know, thank you. There's quite a few policies out there, like job guarantee, for example, which I think is, is perfectly fine. I'm not opposed to that. But I think that the first thing that you need is a commitment by governments to some sort of concept of full employment. Employment is not big on the radar of governments. Look, I truly believe that if there's one thing that the COVID has taught us, is that anything is possible. If the government wanted to create jobs, it could. It's that simple. And I really believe that. We know that you could develop some sort of a industrial strategy. We know that you could develop some sort of maybe import substitution policy, for example. That we can, create direct jobs if the government wanted to. But I don't think the governments want to. I don't think so. I think that a lot of people, a lot of segments of society are happy with, wages being, this is Kaletsky, people, and is optical to full employment. I think that if you create too many jobs and workers are too empowered, you're going to shift power. And I don't think that, and I think a lot of people on, why do we call it Wall Street versus Main Street, right? I think if you give too much power to Main Street, you're going to have a lot of criticism from Wall Street. So to answer your question, yeah, there are a lot of policies, and we can sit down and we can all think about good policies to create employment. And and governments will tell you, oh, it's all market fundamentals and all of that. But in reality, they certainly could do it.
Thank you, Louis-Philippe. I completely agree with you. It's a problem of political power, not of technicalities.
Yeah.
There is another question. Thank you, Marcia, professor from our postgraduate department. She says, thank you for excellent conference, Professor Rochon. Is it possible to redirect monetary policy approach to modify inflation targeting in favor of higher growth? The Fed had in 2007 crisis and during pandemic the advantage of itself helping with zero lower bound interest rate.
Yeah. I think that for me, I'm a Keynesian through and through, or a Kaletkian through and through. I don't think monetary policy should be used to encourage growth or not. I think, and that's exactly what I'm going to be talking about tomorrow. I think that your best bet is sort of, because of this asymmetric nature of monetary policy, where it has no effect at low rates, it has a tremendous effect at high rates, that we should keep monetary policy within a certain range, a medium range, and then, use fiscal policy. One of the advantages of having a lower bound, my sister is here today listening, and just for her and maybe others, lower bound is just basically zero interest rates, or interest rates near zero. So one of the advantages of having interest rates near zero for the past decade or so is the fact that, interest on government debt has been negligible, and that has supported fiscal policy tremendously. Now, for me, this is certainly how I interpret parking rules. Set interest rates low, keep them there, and then give those degrees of freedom to fiscal policy. Fiscal policy can do wonderful things. It can target, it can be general, it can be very specific, and you'd be surprised. And, look, at the end of the day, and I've flirted around this concept, investment, which drives the economy, investment depends on expectations of aggregate demand. And despite the fact that interest rates were zero, investments didn't didn't move. Why? Because the expectations of aggregate demand, and it's not only expectations of aggregate demand. Firms must believe that the expectations of aggregate demand are permanent. If they expect aggregate demand to go up and come back down, right? They must expect aggregate demand to go up and remain there permanently, right? An investment is a permanent increase in the capacity to produce, which has to be met by a permanent increase in the capacity to receive. So, interest rates alone doesn't do anything for growth. I'm not a big fan of using monetary policy to target growth or any other thing like that. I think that we have to use fiscal policy.
Thank you, Louis-Philippe. I should remind that when Latin America had huge rates of growth in the 50s and the 60s, monetary policy was used to finance economic growth, not to hinder it.
Yeah, but you finance it by keeping them low so that governments can spend and absorb the interest payments. Yeah. So if that's what was meant by the question, sure.
There is a request whether you can share your slides.
I will send them to you, absolutely.
We have another question by Mario Aceves.
Wait, there is a Luis Ángel. Si quieres, hago yo y después sigues tú. What would be the subject or sub-subjects that the economy of today and the future should develop to have a more to be more meaningful? I hope, Luis Ángel, I'm translating correctly your answer, your question. Louis-Philippe.
Say that again. What
are the subject or sub-subject that the economy of today and the future can unite for things to evolve? In what shall we deal more? Go ahead, please.
I'm not sure if this is going to answer your question, but I've been hearing for 40 years that neoclassical theory is about to collapse, and it hasn't, and it won't. And I'm not sure what to do to unite or to move forward. We just have to keep going. I mean, neoclassical theory is revealing itself to being quite silly, isn't it? And when I teach it to my students are just going, what? That can't be true. But you're dealing with a lot of powerful vested interest. That's what you got to understand. It's all about vested interest. It's not, it's not about ideas. In the sciences, when we demonstrated that the sun did not rotate around the earth, that theory was abandoned. Look at what I did, and today I've knocked down so many of the elements of that model, but nothing's going to happen to that model. There's still always going to be explanations as to yes, but.
One thing before I handle the microphone to Jorge is please remember that tomorrow we'll start 11:30 and there is another connection, another link to enter the course. Jorge, por favor, sigue haciendo las preguntas.
Okay, Mario Aceves is asked you, could you comment a little bit more on the inefficiency of quantitative easing?
Yeah, I mean, the idea behind quantitativism, I wrote a paper on that actually. Can't remember where, but the idea was twofold. One was to reduce long-term interest rates, so that would sort of encourage investment. Two, it was to give banks more liquidity in order for them to lend more. So there was this concept of the money multiplier, that the reason investment was not taking place is because interest rates were too high and banks were not lending because they didn't have the funds for it. well, that's completely contrary to endogenous money. And so, but those were, if you look at some of the papers by the Fed at the time, the two arguments sort of came back over and over again. But in the end, what happened with QE is that it simply increased the wealth of those asset holders. That's what it was. And there's lots of love. And Pettifer wrote a little book on it. I'm not sure where people find the time, but she wrote a little book on it. And where, QE basically contributed to widening inequality. And tons of, there's so many papers now that come out and say that. And I think that's what QE was about. I have a quote by someone at the Bank of England that said, when interest rates came down, the revenue of bondholders went down. So central banks substituted that in order to support their wealth. So when the revenue of bondholders went down, central banks stepped in to support the wealth. Yeah, we've got a lot of decks stacked against workers for sure.
Okay.
Thank you. Adelante, Jorge.
I don't know if we have enough time for the questions. How much time do we have left?
It depends on Louis-Philippe and Jesus.
Okay. We have another question from Diana Saavedra. What are the effects of monetary policies from developing countries over the developing economies dynamics, taking in account the COVID crisis and the COVID-19 pandemic?
Can I add something to it?
Yeah, of course.
There is an issue that actually mainstream economics dealt with in the issue of the fear to float. If we put exchange rates into the picture, we show it very clearly that the problem that managing interest rate really affects the labor market. And this is something that Calvo, and I think with Reinhardt, wrote. So it's sort of acknowledged even by the mainstream. Go ahead, please, Louis-Philippe.
Well, I get asked those questions a lot, and I think you have a lot better qualified people in Mexico to answer those questions. But for one thing that I've learned is precisely what Noemi mentioned, the exchange rate, which is not something that we discuss much here in Canada. Central banks, Bank of Canada rarely mentions the value of the dollar. The same thing with the Americans. Americans never mention the value of the dollar. So I'm going to leave that question to be answered by specialists in Mexico and Latin America, because I don't want to get into trouble, and two, you really are better qualified.
Thank you.
Okay.
Jorge.
Maybe we have another question. Time for another question. Nancy, I just ask you, nowadays there are biggest transnational enterprises constructing very powerful networks that involve in all sectors. In that way, the political economy is subordinated to the expectations of these enterprises. It is possible that central banks or the political economy in general could be in hands of the government, or maybe the government is just the gendarmerie of that enterprises.
Yeah.
There is another question by Mario Aceves. Did you put it through?
I don't know, Mario Aceves.
Yes. Thank you for your amazing conference.
Okay. Yeah. Could you comment? No, this is.
You do this. Sorry.
Yeah. Louis-Philippe already answered that. Yes, please.
So what am I answering now?
The question about enterprises.
Yeah, I'm not sure how to answer that. I'm not sure I quite understand the question. I mean, I don't know how to link in monetary policy interest rates in that. Sorry.
Okay. Okay.
The one of Luis Raúl.
We have the last question. You have made very interesting point today regarding the validity of actual economic behavior and the assumptions made by mainstream economics thought. I agree with you. They have not all the answers. Where we should look for those answers?
In the data. Look, I firmly believe that the data validates much of what post-Keynesians and heterodox people have to say. You know, when I refer to Paul Krugman's quote where he says we can't find that relationship in the data, yeah, look in the data, you know, I mean, I teach a course where I don't use theory. Every day I just come in and I tell students, let's look at the data on this and this, and let's just be guided by the data. Now, the mainstream would bring up the Lucas critique, but you know, I think the data tells us a lot. That's where you're going to find the data. I tell my students, sorry, that's where you're going to find the answers. And I tell my students, everything is empirical question in economics. So go and look at the data to see what it says, and you're going to see that it invalidates much of neoclassical theory, and it's going to give you a lot of the answers about, you know, I mean, how better to observe the real world as Keynes tells us than to look at the data.
Okay.
You know, the Journal of Econometrics, which was started, I think in 1935, something like that. Econometrics originally was a way to criticize neoclassical theory. It was a way to look at the data and to run some regressions and to say, hey, there's a problem here. There's a discrepancy between the neoclassical theory and the data. Now it got, you know, it got absorbed and taken over and everything like that. But originally, you know, that's what the data was there for.
Okay. The last question. According to the new consensus, the interest rate can be controlled. Does this still hold to open small economies?
Yeah. Let's not mistake the concept of the ability to fix a rate and the consequences. So, I mean, that holds for Canada. We could choose to leave interest rates at zero if we wanted to. There's going to be consequences. Maybe there'll be some capital flights, et cetera, et cetera. And the same thing for the small economy. I'm pretty sure you can have the rate of interest that you want, to quote Keynes, but there's going to be consequences, right? And it's up to you to figure out whether you want to deal with that consequence. So if Mexico wanted to have an interest rate of 1%, it could. But, you know, you're going to have exchange rate problems, you're going to have other problems, but those are different questions. And so that's why, you know, small open economies, developing economies tend to put their interest rates close to where there's very little sort of exchange rate movements in order not to destabilize the exchange rate.
Okay, so I think we have finished with the question, Jorge.
Yeah. It was the last.
Quiero agradecerle a todo el mundo por sus preguntas. Esperemos que mañana se conecten con el link que ya fue mandado. Si tuvieran alguna pregunta, avísenos. Louis-Philippe, thank you very much for your presentation. Everyone is very happy about that. And we hope to hear you tomorrow, 11:30 Mexican time, 12:30.
No, 1:30 Canadian time.
1:30, now it's 2 hours, sorry.
Yeah, because we went ahead 1 hour yesterday. So that's why I logged in at 12:30 and I said, where are you?
Okay, sorry, en la mañana tuvimos así medio...
Unos hackers.
Porque Louis-Philippe me decía, ¿y dónde está la conferencia? Espérate si todavía ya no estamos. Thank you very much then, Louis-Philippe. We hope to see you tomorrow. And we hope that the people will still be interested and link. And I think tomorrow is the challenge what to do. Thank you very much.
Thank you very much to both of you. I'll send you my presentation from today because some people were asking for it.
Okay, thank you.
So Contact, please, thank you, Raquel. Thank you. So please contact Jorge or Noemi if you want the presentation.
Thank you. Gracias.
Bye. See you
Gracias.
tomorrow.
See you tomorrow.